everybody. Good morning or good afternoon, depending on where you're at. Welcome to the November installment of our Flex series. This is going back to since February when we started this. And I'm really excited about today's speaker and what we're going to be talking about. But before we do that, as always, want to thank you for taking the time. We know you're busy. We know it's end of the year. We know you're wrapping a lot of things up as you start to look forward and plan for 2022. And we appreciate you taking the time. Two, obviously, hopefully you come, this comes to you with, everybody doing well, healthy, safe, as we continue to kind of, wade through the pandemic and the ebbs and flows. I know there's some areas of the country that seem to be spiking again with cases and hospitalizations. So hopefully you, your loved ones, your family members are all doing well. And then crazy to think it's November already and we're literally 1 week away from Thanksgiving. So in a lot of cases, you may be seeing family for the first time in a very long time. So hopefully you get to enjoy some time around that holiday with your loved ones and your family as well. And look, so before I bring him on stage, I want to kind of give you an introduction to our guest speaker today. So Rick Sharga is an executive vice president of RealtyTrac. They're a leading foreclosure search and discovery website used by real estate agents and investors throughout the country. Rick is one of the country's most frequently quoted sources on things related to real estate, mortgages, foreclosure trends. He's appeared on places like CNBC, CBS News, NBC News, ABC Fox, Bloomberg, NBR, you name it, he's been on it. He's a founding member of a 5-star National Mortgage Servicing Association. He's on the board of directors of REOMAC, and he was included in Inman News's top 100 as far as annual list of most influential people in real estate and real estate leaders back in 2013, 2014. So we're really glad we have him here for you. So Rick, bring Rick onto stage. Hey buddy, how you doing?
I'm doing well, John. How are you?
I cannot complain. I know we were talking beforehand, all things, Orange County for you, DC area for me. So, looking forward to today's session. I know the topic, obviously, real estate in a post-pandemic market. And then you have some real good content in there related to about 4 different points that you wanted to touch on. So I would tell everybody that's watching, obviously, like always, if you have any questions, you can input them down below. They'll come to us. We'll address them either at the end or as we go through. And so with that being said, Rick, I'd love to just jump right into it with you.
That's great because we have a ton of content to go through.
Yeah.
So I guess we'll go through it, and just kind of warning to everybody, we're going to go through this at pretty much warp speed. But I'm happy to share the slides with anybody who's interested. We're going to walk through a little bit about what's going on in the economy, the housing and commercial markets. We're going to take a look at what's happening in foreclosures and forbearance with our outlook on what to expect there, and then we'll jump into some Q&A. But just to kind of set the context, John, with the economy, because that's what really drives everything in the real estate market. I've had a lot of people talk about the economy being on a roller coaster ride since COVID was declared a pandemic. I really liken it more to a bungee jump. We had a huge drop, biggest single quarterly drop in the history of the country, bigger than the Great Recession, bigger than the Great Depression, 31% drop. The good news about that is, and there was some good news, is first of all, it wasn't as big as some people expected. There were economists predicting 45, 50% drop, and that didn't happen. The reason everybody was predicting such dire things was because as I guess a lot of you know, the U.S. economy is built largely on consumer spending, almost 70%. And with the government shutdowns, really there was nothing to buy, and so consumers were kind of forced to sit on their funds for a while, unless they were the lucky ones who could find toilet paper at the local Costco. The other good thing about it is we saw it coming. The government knew we were going to have a drop because they were shutting things down. And so there was a lot of activity, a lot of effort put into propping up the economy to prevent what was a sudden and sharp recession from turning into a depression or a longer phased recession. And in fact, the following quarter, we had the single biggest jump in the GDP in history. For those of you who, like me, are sometimes challenged by basic math, A 31% drop followed by a 34% increase doesn't quite get you back to where you were. But the other good news is the economy has continued to recover in subsequent quarters. And we're back about where we were, a little bit ahead of where we were prior to the pandemic. Not quite where we probably would have been if we hadn't had that drop and recovery. But again, the bottom line is that the economy has recovered remarkably quickly. I mentioned that consumer spending has an awful lot to do with our economy. And what we're looking at here is consumer confidence. That's the blue bars, and consumer spending. And you can see that historically, those two things go hand in hand. The more confident consumers are, the more likely they are to purchase things, to spend money, take on credit card debt, get a mortgage, get a refi, buy a car. So all of that came to a screeching halt when the pandemic was declared, the shutdown hit, and you see spending plummeted along with confidence. Since then, spending has come back remarkably well and continues to perform and actually outperform consumer confidence. I was talking to a group the other night, and somebody suggested that the consumer confidence issues are related to inflation, and that may be the case to a certain extent. But what I've seen with consumer confidence is every time there's a new COVID wave, consumer confidence drops, and I really believe that's what we're looking at with the consumer confidence scores. I sent Flagstar this deck a little bit ago. We've since seen an improvement in consumer confidence scores compared to the most recent things here, but we're still running below, well below where we were before all this COVID stuff happened.
It's interesting, Rick, when you on that slide, you don't need to go back, but there you go on that slide. It's interesting because I think the natural reaction is to go to inflation, right? And I think that's the normal thought process, but it's interesting the concept of tying it to the spikes and of COVID cases and hospitalizations and the rates when they spike up and down. It's interesting to see that because, to your point, all of a sudden now you have mask mandates. You have from a workforce perspective, people aren't coming back, so businesses haven't necessarily fully opened back up in some cases. So it's interesting because I think everybody's first reaction is it's inflation related.
Yeah, and that's, again, if we weren't dealing with a global pandemic, that would be the likely culprit. But there's no direct correlation between inflation over the last couple of years and consumer confidence going up or down. It really, from a timing standpoint, is almost in lockstep with waves of COVID. The other thing about the spending I should point out, and for this audience, I think it'll be particularly important. A lot of the spending is probably primed by government stimulus. So we've had $7 trillion injected into the economy in an attempt to manage our way through this COVID recession. And consumers are spending it. They're also saving it. So savings rates are at historical highs. And because of that, there's a lot of capital sitting on the sidelines right now waiting for a place to go. And part of that's what's driving housing, which we'll get to in a minute. Unemployment also spiked remarkably, and overnight we went from 3.5% unemployment, which was the lowest rate we'd seen in 50 years. We had record low levels of unemployment for Black workers, for Hispanic workers. We had a record number of women in the workforce, and that all stopped literally in a week. We went from 3.5% to almost 15% unemployment overnight. A couple things that were different with this recession and unemployment from prior recessions. One is how quickly the market recovered. And you can see how fast the numbers started to go down. There was just a jobs report that came out this morning. Unemployment claims were the lowest they've been since prior to the pandemic today. I think it was around 260,000 claims, way down. And the dotted line you see here is continuing jobless claims. So people that aren't filing new claims but haven't been able to find work yet. And that number is almost back down to where we were before the pandemic was declared. So that's one thing that's very different. The other thing that's very different, and just put that in context, John. You and I were talking about the Great Recession before we got on air today. During the Great Recession, it took a full decade to recover all the jobs that have been lost. So unemployment peaked at about 11% during the Great Recession, but it took the end of the Bush administration, the entire 8 years of the Obama administration, and the beginning of the Trump administration until we secured all the jobs that we had lost. Excuse me. In this case, by 2022, we will have recovered 100% of the jobs. So just an unprecedented recovery. The other thing that was very different is the job losses in this recession were focused on a handful of industries in the service sector: travel, tourism, hospitality, restaurants, retail, entertainment. Those industries really got clobbered, and that was largely due to the government shutdown and people being reluctant to venture out during a pandemic. That's also been the slowest group to recover. We are starting to see those jobs coming back. I do not believe it's a coincidence that we're seeing job increases in those industries right after the federal government's enhanced unemployment benefits ran out. That's one of those blinding glimpses of the obvious kind of moments. But as of the time this was reported back at the end of August, we were already over 75% of the jobs recovered. But that leisure and hospitality industry areas are one of the laggards. And if you're in a market that's heavily dependent on those industries, if you're in Las Vegas or Orlando or here in California, where a lot of the economy is tied into those service industries, you're probably not recovering as fast as the rest of the country. So, for example, while unemployment the last time it was reported was down to 5.4%, in California it's still a point and a half higher, or not a point and a half, but over a point higher than that, just because of the variability in the types of jobs around. But this is also the reason that the housing market wasn't hammered as much as people expected. You know, you lose 22 million jobs, you expect carnage in housing. People in the service industries tend to be younger, they tend to have less formal education, they tend to be making lower salaries, and because of those factors, they're much more likely to be renters than homeowners. And so this was a kind of bifurcated recession where people at the lower end of the wage scale, those service industry people, got hit harder than a lot of white collar professional jobs, and the housing market is definitely reflective of that. We mentioned inflation earlier. This is what it looks like right now. So wages grew by about 4% last year, but the consumer price index and inflation are at about 5.5%, approaching 6%. The administration and the Federal Reserve are adamant that this is a transitory event. For those of your listeners who are not don't have an advanced degree in government linguistics, I'd like to explain the word transitory. That means we're not sure why this happened. We're not sure how long it's going to be here. Hey, look at the pretty bird. Isn't that a pretty bird outside? So most of the economists I speak to, in fact, all the ones that I respect, are of the opinion this is not a transitory event. This will continue at least well into 2022 before it gets under control. And my one warning for people listening here, if you're looking for what could be an impact on the housing and mortgage markets, is if inflation continues to rise, the Fed will feel compelled to act. And when the Fed acts, they typically kind of hit the brakes. Imagine being on an icy bridge and knowing that you're starting to skid. There's a way you steer and you kind of tap your brakes and you come slowly to a safe stop, or you get back under control, or you can slam on the brakes and skid into a ditch. When the Fed addresses runaway inflation, they tend to be on the slam the brakes side of the equation. And if you look at most recessions since World War II, a likely culprit was the Federal Reserve slamming on the brakes, trying to prevent things from getting too overheated. So if there's a recession on the horizon, it is most likely going to be the Fed causing it by trying to slow down inflation. Not saying that's going to happen, but if there is a risk, that's probably what it is.
Interesting, because you can look at that historically, right? As far as how, I like how you described it transitory, right? Because I think some people do get lost in the government speak. But it is interesting if you go back historically, right? And you see when you have runaway inflation, the reaction is to suppress it and to do it as quick as possible, right? Rather than maybe addressing it over time versus, hey, it's transitory, it's not an issue, and then until it becomes an issue, right? And then the reaction tends to be quick and swift.
Yeah, and there are factors that will continue to drive inflation. Supply chain disruption is clearly one of them. I'm just outside ground zero of supply chain disruption with the ports of Long Beach and Los Angeles, where cargo ships are backed up, into the Pacific. And the other is pressure on wages, which are also an inflationary factor. So the holy trinity right now is supply chain disruption, wage growth, and energy prices escalating, as OPEC kind of has us over a barrel, so to speak. And those are the things to watch for as we try and get inflation under control next year. The good news for our audience, John, is that the housing market has been extraordinarily strong. The blue bars here are 2020, and you see we had a very unusual year in 2020 because our spring selling season basically disappeared when the pandemic was declared. In fact, I was doing a session with a very well-known real estate analyst who predicted that home sales would be off by 40% in 2020. And at the time, it wasn't an unreasonable prediction because we'd lost spring. But what happened was we had an incredible second half of the year and a particularly incredible fourth quarter. Those are some of the strongest October, November, and December home sales numbers I've ever seen. And so keep in mind, as you're reading headlines for the next 2 months, you're probably going to see headlines that say home sales down year over year, and that's okay. What you want to do is watch how they compare to prior months, and what you want to watch for is how they compared to 2019, which was a more normal year. But it would not be at all surprising if we had really strong home sales reports in October, November, and December, but they were still worse than last year because last year was just an aberration. Same thing with new home sales. New home sales started the year on fire and did slow down a little bit during the middle part of the year, seemed to be on their way back up. We were on pace early on to possibly sell 1 million new homes this year, and we might have been able to do it, except there's just not enough of them to go around.
The inventory, right? That's right.
It's inventory. Well, it's funny you mentioned that, John. So this is existing home inventory levels, which are historically low, but you could make the same argument for new homes. And in fact, if you were to look at completed new homes available for sale, there's less than a half a month supply right now, which is just remarkable. In a normal market of equilibrium, there's about 6 months supply of existing homes and about 4 months supply of new homes ready and available for sale. Right now, we're looking at about 2.5 months of existing homes and half a month of new homes. The builders were working around that by selling properties that were in construction or selling properties where they hadn't even broken ground yet. And they've literally started slowing down that process in the last half of this year because of supply chain issues. So they're reluctant to enter into a contract to complete a home by a given date if they're not sure they're going to get windows for the next 6 months or appliances for a year, or if the cost of roofing materials might just go up 50% next month. And so
That's right.
Because of all that uncertainty, and because candidly they're having some trouble finding enough labor to meet demand, we're seeing a slowdown in both of those. The good news, such as it is that we are starting to see a little bit of a change in year over year existing home inventory. We're about to hit a seasonality issue where most people don't list their properties in November and December. But it's at least trending in the right direction. And the other good news is housing starts have improved significantly. We've had a lot of starts, a lot of permitting activity. So it's likely we'll see the builders come to market with more assets next year. While this is happening, demand isn't slowing down. So this is the Mortgage Bankers Association Purchase Loan Application Index, and it's showing how many people are applying for purchase loans. They're still forecasting that this year will be a record year for purchase transactions, probably somewhere in the neighborhood of $1.6 trillion of purchase loans. And they believe next year will be even stronger. So that dark blue line running kind of toward the middle of the page is 2021 numbers. And the only year that 2021 is lagging behind at this point of the year is last year. And as I mentioned, you can see how unusually that red line performed compared to every other year on this chart. So no activity during the spring, and then unusually high activity during the winter. But the bottom line is the purchase loan activity it indicates that demand is very, very strong. It's being driven by 2.5 trends. One of them is demographics. Somebody said demographics is destiny. I don't necessarily dispute that a bit. The millennials, largest generation in the history of the country, the largest group of them is rapidly approaching the prime age to be a first-time homebuyer. We're going rapidly from a point where we had the highest percentage of young adults living at home with their parents during the pandemic to having, I believe when the reports finally come out from the Census Bureau, a huge spike in household formation. So the millennials are not only causing demand to be very high in terms of owner-occupied housing, they're also causing rental vacancy rates to be historically low. If you look at multifamily vacancy rates across the country right now, they're around 2%, which is just extraordinarily low. And so this is one of the big drivers. We just have a lot of households being formed by young adults. The other, and you and I were talking about this chart, is we're still looking at historically low interest rates. RealtyTrac's parent company is Atom Data Solutions. And Atom recently put out a report that showed that in more than half of the markets across the country, it's actually less expensive to make an average mortgage payment than it is to make an average rent payment. And this is driving a lot of fence sitters, over the fence and has them looking for homes to buy as opposed to places to rent. It just makes a lot of sense. This is also why people have still been able to afford homes despite prices going up as rapidly as they have. You really can't overstate the impact these low interest rates have had on home affordability and on the demand for housing. I mentioned 2.5 trends. The other is that the pandemic itself, oddly enough, accelerated the trend we were seeing of urban renters becoming suburban home buyers. We've seen people looking for bigger properties, more space between properties, properties that have that home office, since they'll be able to work from home all or part of the time. And that trend has gone from the suburbs to the far suburbs to even some rural areas. So it's been it's been an accelerant. We were seeing that trend prior to COVID, but COVID really ramped that up pretty quickly. All of this supply-demand imbalance has led to higher prices. I get asked the question quite a bit whether or not we're in a housing bubble. I do not believe we are yet. If we keep going up 18, 19, 20% year over year, we'll get there before too long. But we're not. And I'll just a couple things for people to think about when they see reports on how high median home prices are. Remember, going back to 4th grade math, that a median is the midpoint between the lowest and the highest point in a given scale. There's virtually nothing being sold at the low end of the market right now because there's no inventory. So that means the bottom of the scale has been moving up, which moves that midpoint up with it. So one of the reasons the median prices are as high as they are is because of the product mix. There's just not a lot selling at the low end. The other is that a lot of people are trading in the equity that they've accumulated as prices have gone up and moved into a more expensive property. So it's there's a higher percentage than usual of move-up purchases. And these are not people who, like in 2008, were getting negative amortization loans or 100% financing, 0% down. They're really using that equity to significantly pay down the new property and keep their mortgage rates, their mortgage payments affordable. So very different scenario. Also, there's the Boise effect you and I were talking about, John, which is we've seen people move out of high-cost markets like the Bay Area in California into low-cost markets like Boise, Idaho, which has the largest single year-over-year price increase rate in the country, over 45% home price appreciation in a year. And that's because people are coming from these high-priced markets and paying cash for a new property, and they don't care if they're paying 30 or 40% over market because they're paying cash and they're still able to put money in the bank. Kind of interesting one-off phenomena. Some of those markets, I would not be surprised if we saw a little bit of a price correction as we get into 2022, because the prices probably did get out over, kind of more realistic numbers. and the price increases are driving equity to all-time highs, $23 trillion in homeowner equity. And you can see that mortgage debt really hasn't gone up nearly as rapidly or as high as equity. I'm getting ready to publish a report because the pushback I usually get from people here is that's good overall, but those people in default, those people in foreclosure, they probably don't have equity. Well, turns out 87% of them do. And a surprising percentage of them have 25 or even 50% equity in their homes. So this, again, is not like the Great Recession when a third of borrowers were underwater on their loans. Today's borrowers are in much better shape and should be able to get themselves a much softer landing than their predecessors in the last cycle. The commercial market has performed a little differently than the residential market. If we'd had this discussion a couple months ago, I would have been telling you that the market had not nearly recovered. Prices were down, sales volume was down. Then we got to the end of the second quarter, and lo and behold, the volume of sales activity got right back up to where it has been on an average over the last 5 years. So not a record-setting quarter by any stretch of the imagination, but the first really healthy quarter we've had for quite some time. If you follow the commercial market, you know that the fourth quarter is always the busiest quarter. People trying to get deals closed, both from a cash perspective and from a tax perspective. All signs point this year toward a pretty healthy Q4. As we're recovering, though, we're recovering at very different rates, and different markets are recovering differently. So if you were to look at a chart showing recovery by major markets, what you would also see is that the real big commercial markets, Los Angeles, New York, San Francisco, DC, Philadelphia, Chicago, are all actually still below where they were a year ago. It's the secondary and tertiary markets where all of the growth has been, and that's true both in sales volume and in prices. So again, we've seen more of a movement away from those huge metropolitan areas into the smaller markets. Some of them are tiny. They're markets like San Diego or Austin. But again, they're not quite as big as the San Franciscos and Los Angeleses. The only two categories of the commercial market that really have come out ahead are the multifamily market and the industrial market. And the industrial market had a record-setting year in 2020 because a lot of people were limited to buying things online, couldn't get out to buy things at stores. And all those online retailers needed warehousing and distribution centers closer to the end customer. So we've seen sections of the country, John, you're in one in Virginia, where some of the suburban and exurban areas of the state have seen a huge growth in warehouse and distribution centers. Central Valley in California has been sort of the same thing, and it's happening across the country. Also a demand for cloud computing centers because of the work from home movement and people having the opportunity to be remote, and so you're not dealing with centralized server situations in an office. The retail sector has fared better than I expected, but only because retail centers are being sold now and repurposed into a variety of things, not the least of which, interestingly, is residential use. So we're seeing some apartments, some condos in what used to be retail centers or what are now mixed-use centers. And there's a lot of talk about suburban shopping malls perhaps becoming an area where you can have senior residencies because it becomes sort of a closed, self-fulfilling environment or ecosystem for people to live there. And the good news for me is it would give my mother one more chance to be correct, because when I was a teenager, she said, you're at the mall all the time. Why don't you just live there? And as a senior now, I could do that.
Yeah, I think that's going to be the interesting thing moving forward from a commercial perspective, right? Is how do you repurpose some of these, facilities, buildings, right? Take it from a non-traditional use into a different type of use to repurpose it. I think that's going to be interesting to watch the commercial market as we move forward.
An investor talked to me the other day about a church he purchased in San Diego that he's converting into an 8-unit multifamily property. And during my time at auction.com, we sold a suburban mall in South Carolina to a municipal government who decided to put all of its offices in the mall. So yeah, I think we're going to see a lot of creative reuse. The two markets that are most of concern are the hotel sector where we're in the second year now of below normal occupancy levels. A surprisingly high number of owners of small hotels, limited service hotels, Hilton Garden Inn, Marriott Residence Inns, are individual investors who may not have the financial wherewithal to weather, a second consecutive year of low business. We're seeing a lot of hotels being sold. My guess is they're being sold at distressed pricing right now. We've even seen some bigger hotels go into foreclosure. The Marriott Manhattan East was foreclosed on. The Roosevelt Hotel, which, if you've been in the mortgage industry long enough, you've probably been at a conference there, was also foreclosed on. So the hotel industry is kind of a little shaky. And the office market, I don't know that we're going to see the full impact of working from home on the office market for another year or two because of the length of office leases, which kind of protects building owners for a while anyway as we go through this. And one of the things I wanted to share with the group, John, is that we've seen the sales prices of these properties recover and actually be ahead of where they were a year ago, with one exception, and that's the central business district offices. Suburban office prices are up about 7% year over year. And those big city office buildings are still trending at prices lower than they were a year ago. Same thing is true in terms of rent. I mentioned 2% vacancy rates in multi-channel properties across the country, apartments. This is actually a conservative estimate. The last one I saw had those rents on new rent asking prices up 12% year over year for apartments. To put that in perspective, this is an industry that routinely, and you can look back over the last 10 years here, but routinely goes up about 1 to 5%. So 12% in 1 year is just insane. Industrial rents are going up, even retail rents are going up a little bit, but look at the office sector being below normal. So again, this is the sector that I'm most concerned about in the commercial market. If any of the attendees are looking for opportunities for distressed assets, I think the small hotels, the small offices, and then to a certain extent, the small retail centers are going to be places where you can look. And just to kind of give you an idea of what we're dealing with, this is what we're tracking at RealtyTrac in terms of foreclosure activity for commercial properties with loans higher than $5 million. Now, I want to put these in context for you before everybody freaks out. That really, really big spike in September took us all the way to 41 foreclosures. So we're not looking at massive numbers of foreclosures. I'm showing this because if you were to look at September in prior years, you're looking at maybe 15, maybe 17 properties being foreclosed on. So it's not necessarily the number, it's the relative number. And we've seen a spike in those relative numbers since the pandemic. More of these properties going into foreclosure. And just to kind of to round us out, John, the last thing we want to talk about today was where we see foreclosures going. There's been a lot of talk in our industry about abnormally high serious delinquencies on mortgages, and that's true. But again, let's keep these things in context. We saw delinquencies spike right after the pandemic hit. The quarter afterwards, we had higher serious delinquency rates than the highest we had during the Great Recession. We've seen delinquency rates now fall for 10 consecutive months. And one of the things that Mike Fratantoni, who's the MBA's chief economist, pointed out to me was that, you can usually track delinquency rates along with unemployment rates. And in fact, they've been tracking almost in lockstep. We had the huge spike in unemployment, huge spike in delinquency rates. As unemployment has come down, so is delinquency. The other thing I'd point out is that the early stage delinquencies, the 30 and 60 days, are now at the lowest levels they've been since the MBA started tracking these numbers in the 1970s. So there's virtually nothing new going delinquent right now, which is, I believe, a sign of recovery. The delinquencies we're seeing are not the same as what we saw during the Great Recession, or for that matter, at any time in history that I can recall, because most of them are in the mortgage forbearance program that the government put in place to help offset the likelihood of foreclosures due to the COVID pandemic. And at the peak of this, we had about 4.4 million people in forbearance. We are now down to about 1 million people in forbearance. We've had 8 million through it all told. And that means that 7 million people have entered and exited the forbearance program since it started, and delinquency rates have steadily decreased. So I would suggest to you that the people exiting the program are doing so very, very successfully. And in fact, even the most conservative way of looking at this is that at least 84% of them have exited successfully. And by that, I mean, we look at how they left the program. 20%, almost 21%, never missed a payment. So these were people that were in the forbearance program who may or may not have really needed to be there. But throughout the whole period they were there, they continued to make their payments and did so after they left. Another 12% simply had their loans reinstated. Then about 41%, 42% either entered into a loan modification or a deferral or partial deferral plan. And if I'm sure your audience knows this, but the deferral program for these loans, particularly the government-backed loans, is that you take all the missed payments, and if the account had an escrow account, that also includes taxes and insurance, and you park them at the very end of the loan. So if you're 5 years into a 30-year fixed rate loan, you don't need to worry about those missed payments for another 25 years. So I believe the percentage of borrowers exiting with a loan modification will increase as the last million people exit. But these numbers, the MBA started collecting them in June of 2020, and they really haven't shifted all that much. About 7% paid off their loan, probably by selling the property or doing a refi. About 17% left without a plan in place. The MBA tells us that about half of them ultimately wound up in a loan modification or deferral plan, but they hadn't quite completed those plans before they exited. And the rest of them wound up cycling back in. They'd exited the program. They still weren't ready to get back on their feet financially, and the servicer put them back in. So less than 1% have left via a default, a deed in lieu, a short sale, or something else like that.
Well, it's interesting, Rick, this slide, and obviously being one of the bigger servicers in the country, right? Servicer / sub-servicer. We obviously, this lines up with a lot of the performance that we saw, right? Especially, I think the one that stands out the most to me is the fact of how many people actually entered into forbearance, almost took it as a safety net, right? Like, yeah, I'm going to do this, but I'm going to keep making my payment anyway, and never missed a payment along the way, right? So the performance was outstanding. And then you touched on it earlier too, Rick. I think the difference this go around was in your presentation earlier, right? The equity that people have in their properties, the type of loans and product that they have on the house, right? It's not something where, these people are exiting and they owe more than what the house is worth from that standpoint, right? They haven't gone upside down type of thing. I mean, think about it. If you were coming out, at the end of the day, you've probably built up some pretty good equity over the last 12 to 18 months. Yes. You're not going to walk away from that. You're going to put it on the market and then start looking at what we were talking about earlier around inventory and lack of it. And I think you quoted new home sales is like half a month, and resales are at like 2.5 months, right?
Yep.
These things are going to go, and they're going to go above market more than likely based off of how many people are going to put offers in, and we're back in the bidding wars and escalation clauses and all that stuff. I think this was a lot of concern for people in relation to inventory, that what would happen. And clearly it's I don't want to say the exact opposite, but the effect that people were thinking, we're not realizing that for a lot of those reasons.
Yeah. You spelled out the whole case there, John. Did a great job of it. There are probably some people who were in the forbearance program because they just decided they had something better to do with $2,000 a month than pay the servicer.
That's right.
But the bottom line on this is I do believe the government and the industry work together amazingly well, and have probably prevented 4 or 5 million unnecessary foreclosures.
For sure.
The other thing you didn't mention, but is a factor, is how rapidly the economy recovered. During the Great Recession, you lost your job, you're going to be out of work for a while.
That's right.
And even if you had equity, you weren't going to be able to make that monthly payment. That's not the case this time around. People have been able to find jobs. In fact, there are more jobs open today than there are people looking for work, which almost never happens.
Yeah, so right. When's the last time that existed? Right.
I don't know, but we'll find out. But yeah, for all the reasons you just laid out, the fear was that forbearance equaled foreclosure, and that's turned out absolutely not to be the case. And if you look at foreclosure activity, you can see where we were during the Great Recession back '08 through probably 2012. We got back down to more normal levels over the last couple of years. And look how far off we are in terms of normal foreclosure activity.
That's a great slide, Rick. It just sums up what we were talking about. I love the forbearance equals foreclosure concern.
Yep.
I mean, that says it all right there.
So the real question we get is, so what happens next in foreclosures? And here's my back of the envelope guess. So there were about 250,000 loans in foreclosure before the pandemic, before the mortgage forbearance program and foreclosure moratorium. Most of those loans were still outstanding when the moratorium ended. When I wrote this, there were 1.2 million loans in forbearance. Let's just use that number, even though we're down to about 1. That means that about 16% of those were leaving without a plan in place. Most of them did okay, but let's assume those are the most vulnerable. So that's another 192,000 people. And the rate of loans in foreclosure prior to the pandemic was about 0.6%. So over the course of a year, that would give us another 300,000 loans in some stage of foreclosure. If all of that happened, the 250, the 192, the 300, we'd have roughly 742,000 loans in some stage of foreclosure, which is about 1.5% of the overall total, sometime over the next 12 to 18 months. And they wouldn't all hit at once. You're a servicer, so you know this. A lot of the loans that were in the mortgage or the foreclosure moratorium were in foreclosure for so long that they've exceeded the state guidelines.
That's
and
right.
have to be restarted. So it's not like you flip a switch and finish the foreclosure. Every state has its own timelines. So these properties are going to come into the pipeline at different speeds and at different times. But again, to keep all this in perspective, during the Great Recession, the peak of foreclosure activity was 4%. So in my worst case scenario world here, and you and I both know that, some of the loans that were in foreclosure were also in forbearance, and some of the loans that are in forbearance would be in that 0.6% that would go into foreclosure. So a lot of duplicate numbers in here. Yeah. Unlikely we're going to see 742,000 loans in foreclosure in the next year and a half. But again, that's kind of worst case scenario in case people really are curious about what to expect going forward. That's all I prepared for today. I probably ran a few minutes over my time.
No, we're good. I would say a couple things or a couple questions came in. We got a couple on, is this being recorded and can we have the deck? The answer to that is yes, it is being recorded. So you can go back and view it. B, our AEs, i.e. your account executive, will have access to the materials that Rick shared today. So we can obviously get that to you. And then Rick, there was a couple questions just to kind of get your thought process on, and the topic was the same amongst the 3 or 4 people that asked the question. And I'll just read one and then it kind of gives you a feel for what the other ones look like. It was thoughts around the news surrounding Zillow, whether this is isolated to them versus more of a ripple effect through the iBuying kind of concept. Any thoughts on that?
John, if your viewers were following the RealtyTrac blog, they would have seen a brilliantly drafted article called "Instant Overreaction," talking about Zillow exiting iBuying. My perspective on Zillow. A lot of questions came out. Does Zillow see something in the housing market that made them panic and get out? No. Zillow saw something in their numbers. Published reports had them losing $310 million in the last quarter on their properties. They have another 18,000 properties either that they own outright or have under contract, and they've agreed they will honor the contracts that they expect to lose 5 to 7% on as they resell those. So investors typically make one of 2 mistakes when they fix and flip a property. They either overvalue the property and pay too much for it, or they underestimate the cost and the time involved in bringing it back to market. And it looks like Zillow did both of these mistakes. And they did it at a very large scale. So as much as there are economies of scale, taking a small business and growing it, the flip side is if you make a mistake in your business model, it can lead to dramatic and disastrous numbers. And that's exactly what happened in Zillow's case. The other major iBuyers seem to have been able to tighten their buy box a little better and have gone from marginally unprofitable to marginally profitable. I'm also looking at them starting to add ancillary businesses to their core business. They're talking about offering title services, offering mortgage services. So even if the house becomes a loss leader, they theoretically can make money on the ancillary services. I also suspect, two other quick points. I also suspect that the iBuyer market will go the way of the single family rental market. We had a lot of noise when Blackstone, BlackRock, and American Homes for Rent and Starwood entered the single family rental market, buying properties. Turns out collectively they still only own between 1% and 2% of all the inventory. But their entry caused mid-sized investors, regional players, to spring up and start buying properties in a given area. I'm already starting to see that in the iBuying front. In certain markets, we're seeing local iBuying activity. So it's a local investor who doesn't have to worry about scaling nationally, who's a local market expert, knows the trends, knows the prices. And I suspect we'll see more of that kind of iBuying opportunity in the future. And then the last point, because realtors love this, no, I don't think this is the final death knell for the Zestimate. The Zestimate, nobody from Zillow has ever said the Zestimate was 100% accurate. Nobody's ever said that. In fact, they tell you get an appraisal, get a CMA, do comparison stuff. But if you look at the numbers, they're about within 1.5% to 2% of list price across the country. They're within about 6%, 7% on properties that aren't listed. I think the issue was more with what Zillow did adjusting their purchase price to the Zestimate and anticipating what it was going to cost to get it back to market rather than the Zestimate itself. But as an estimating tool, the Zestimate just is what it is. Still very popular among consumers.
Sure.
But it was not the core reason that Zillow failed in this activity.
Well, and you honestly, you answered probably 2 or 3 of the follow-up questions around the whole iBuying topic and what that looks like, if it would be kind of the final death nail, and is it going to continue to move forward? And the answer is yes, right? It's not the death. The answer is no, it's not the final death. It's going to continue. And to your point, I think you're going to see it become more, regionalized, right?
Yep.
Where the person is in the market and there's that market expertise that they have. The other thing somebody put is around that iBuying, right? And again, I'm not going to go down the path of are they going to have a good or bad fourth quarter or Q4 type of thing. But like just thinking in terms of 22, 23, housing price index, appreciation slowing, leveling off. Yep. How do you see the impact of the iBuying in that world as well, or in that scenario?
I have to tell you the truth. I early on, I was skeptical of the iBuying model in general, and particularly in a seller's market, because for the life of me, I couldn't figure out why any seller would take less than full market value,
right?
In a market where people are doing multiple bids. So I think if the iBuyers manage their numbers correctly, they can actually survive even in a market that's trending down. They just have to buy for a deeper discount than what market prices are de-escalating to.
Yep.
So it really comes down to your how accurate you are with your assessment of market trends, understanding that local market, and making sure that you have your pencil as sharpened as humanly possible. So I think the ones that are still here have done a better job, and I think the ones that will follow, the local market people, will have their finger much more tightly on the pulse of that local market and be able to kind of navigate ups and downs. It will be interesting to see if we have a sudden correction in the market, and that's something an iBuyer is very vulnerable to. If you're sitting on a whole bunch of overpriced property, not able to recapitalize those things, and your carrying costs are going up,
right?
That does conceivably become an issue. But we've only had one huge market downturn in the last 100 years. So the odds of having another protracted downturn, kind of small.
Well, and I think to your point too, I think companies will evolve, right? And the business model will continue to evolve. So like you mentioned, we'll branch out into title, they'll branch out into mortgage, and again, that becomes a competitor for a lot of the people that are
Yep.
looking, watching this today, right? Because it's our business partners from a lender and broker perspective. Um, but to your point, you use it, right? You can almost use the house in some instances as a loss leader, as long as I can make up that loss in other ancillary services that support the business, right?
Yep.
Um, Hey, I was gonna say thank you and tell everybody, man, there's a lot. A, I would encourage you to rewatch it. And B, there is so much data here that will help you as you're moving into 2022, strategizing as an owner of a company or as an individual LO owning your own book of business. And then another question popped up: thoughts on renovation lending. I figured I'd ask you that just as we, because to your point, there is a lot of untapped equity that's been built up, right? There's a lot, the savings rate, you mentioned it. I forget the number of the statistic, but it's at an all-time high. Again,
Mhm.
some of that was propped up by the stimulus checks and then not
Yep.
being spent. And then you have the supply chain issues, the labor issues. I mean, one of the things you talked about eloquently around the home building and everything associated with it. But just think back to when lumber, and A, we wouldn't take it in from Canada, and then B, the price went through the roof, right? So thoughts on renovation lending as we move forward?
So I'm a big fan of renovation lending. Love the FHA programs. Um, I don't know where Fannie and Freddie are. They were talking about relaunching theirs. I think we're not in the right market for them right now. We're talking about iBuying a minute ago, and iBuying is fundamentally different from a fix and flip in that it's really pretty much arbitrage. You're
That's right.
you're you're buying an asset. You're really
That's
not going
right.
to put any money into it. You're going to try and sell it for more than you paid. Fix and flip, on the other hand, and this is where the renovation loans come in. If it's an investor, fix and flip, a lot of the value you get back from the sale is based on the improvements you put in. That's one way to use a renovation loan if you can get an investor renovation loan. If you're a home buyer and are handy, it's a good way to buy a property like a foreclosure property, like the kinds we have, sales pitch on RealtyTrac, or from the auction companies. But the problem you have today is that's a difficult loan to close a deal with if you're competing with a bunch of cash buyers or with people with conventional financing who don't have any contingencies. So my the it's not a down thing about renovation loans. It's just my perspective is it's probably tough in most markets to be successful using that for your financing simply because there's so much competition for whatever's available on the market.
Makes sense. Well, hey, Rick, I can't say thank you enough for taking the time out of your busy schedule to come on our Flex series. We've been trying to do this all year. We started in February. It's once a month, and we're really just trying to bring content to our business partners that they can utilize, strategize around, and then move forward in the marketplace and help the consumer, right, the borrower on the other end. And man, you hit on a bunch of things today that I think are important as we move into 2022. So I can't say thank you enough for coming on board and doing this today.
My pleasure, John. Really appreciate you guys inviting me. Love to do it again sometime. So, but next time you got to get rid of that cowboy helmet behind you for me next time, man.
I left it in there just for you, man. I actually moved it around so it would be in full, so you could look at it every time you looked at me. It was cool.
My two favorite teams, John, the Eagles and whoever's playing the Cowboys.
Well, I told you this story. I grew up just outside of Philadelphia, South Jersey, right? So it was fun growing up as a Cowboys fan in the 70s and 80s. It was fun.
That's why you moved into Virginia to escape all that. I got it.
That's right.
Anyway.
Well, hey, Rick, I appreciate it, man. Have a great day. And
you too.
hey, for everybody on the call, we got our next one coming up in December. We'll pull that up in a second. But I will tell you, there's a bunch of notes that I wrote on that. On Rick's presentation, some of the data points. I mean, the own versus rent scenario never been something probably more beneficial today than ever, right? With the cost of rent versus what it would cost to own. I mean, you can show somebody some really good statistics around the power of owning and having a mortgage versus renting today. Obviously, I still keep saying this. I still think the numbers are going to shake out. It's probably going to be one of the all-time record years on just the number of transactions that were cash transactions this year. I truly believe that's a delayed financing opportunity, right? So while refis may go down and rates may tick up, you have people that have paid 100% cash over list price in a lot of instances that, there's a market there that's untapped, and there's just a lot of other really good data points that you can use to educate realtors, educate your referral sources, educate your borrowers that you stay in contact with. So hopefully you took a lot away from there. Again, you'll get the content from our AEs, and please, certainly go back on and view this again if you want to rewatch it. And then, as you can see, we pulled up the slide for our next series. It'll be on December 16th. It'll be the last one of the year. And we're actually bringing on our EVP, President of Mortgage. So Lee Smith, he has everything mortgage related. So sales, operations, servicing, you name it, it all bundles under Lee. And then Sandra Danello, who's our President and CEO at Flagstar, are going to come on board and kind of give you some of their thoughts from an executive perspective on the industry, what they're thinking and what they're feeling and seeing for 2022. And then certainly talk about, some of the things, that you can expect to see from Flagstar in the coming months and weeks as we move into 2022. So again, appreciate it. I know this one ran a little bit longer than normal. Apologize for that, but I thought there was a lot of good content that you can take away. So again, thanks for the time, and I'll leave you with, I wish you all safe travels if you're traveling next week for Thanksgiving, and certainly enjoy the time with family and friends around that holiday, and stay safe. So have a great day. Thanks again. See you next month.